How's it going, everybody? It's your boy Mike from Seattle, and today we're going to be comparing and contrasting the investing advice given by Dave Ramsey versus the Money Guy Show when it comes to mutual funds. Now don't worry, I know that you're probably also interested in index funds and ETFs, and I have another video coming about that. I'll put the link to that video in the description below. Now, this is the second video in my series comparing these two financial gurus, so I'm going to do a quicker bio than last time. Alright, ladies and gentlemen, welcome to the main event. In this corner we have Dave Ramsey, the reigning financial guru champion, with more views on YouTube, more years behind that radio microphone, podcasting and broadcasting than anyone else. It seems like no one will ever rise to the occasion to beat Dave Ramsey. Dave is an American personal finance personality, radio show host, author, and businessman, evangelical Christian, and hosts the nationally syndicated radio program, The Ramsey Show, and has a YouTube show by the same name. In the Challengers Corner, we have Brian Preston, the founder of the award-winning Money Guy Show, which has been broadcasting for over 15 years. Sitting beside him is Bo Hansen, his co-host of the Money Guy Show. Both Brian and Bo like to share guidance and insights on topics ranging from clipping coupons to saving for retirement and everything in between. Will these two underdogs be able to topple Big Dave? Only time will tell. Now that the introductions are finished, let's get a quick definition out there for what a mutual fund actually is. A mutual fund is an open-end, professionally managed investment fund that pools money from many investors to purchase securities. Last thing before we get started, guys, down in the comments below, if you invest in mutual funds or if you invest in index funds or a combination of both, please leave what you do, how long you've been investing, and why you like it, maybe even your rate of return. Leave that down in the comments below. Lastly, I scoured through hours and hours of footage of Dave and the Money Guy Show, clipping and compiling to the best of my ability. I'll put the links in the description for the videos that I used, but if this is beneficial to you, please, for the hours of work I put into it, if you wouldn't mind taking the 1/10 of a second to click like and subscribe for me, it would really mean a lot. So my plan here is to talk about the pros of the mutual funds, the cons of the mutual funds, whether or not they are endorsed by the Money Guy Show or Dave Ramsey, what you can expect with your investment. We're going to start with Dave Ramsey first. So Dave's philosophy when it comes to why he thinks you should invest in mutual funds is a couple of different things. Now, unfortunately, he doesn't break it down and say it in quite as simple of terms as I'm going to do here, but that's the point of this video. Dave thinks that mutual funds are easy, and they are more likely to help someone actually get started investing.
The number one reason people retire with no money is not because of rate of return. Okay. And it's not because of the fees. It's because they don't put any freaking money in retirement. Okay. A large number of mutual funds underperform the market, but there are plenty of them that outperform the market.
So Dave right there just talked about how it's extremely important to get started, and the reason that most people don't have anything saved for retirement is because they fail to start. The next thing he talks about is the rate of return, and he acknowledges that a large number of mutual funds don't do as well as the stock market does, but that a lot of them do better. And Dave is interested in beating the market, as you heard him say right there.
And I own several mutual funds that have averaged well over 12%. And what we do is we get people to actually invest. Are they going to get 12%? No. They might get 14. Are they going to get 14? No. They might get 18. Last year, it wouldn't have been unusual to get 18 in that year.
So right there, Dave talks about how you can get 12% or even better. Now, for a lot of people out there who are skeptical as to whether or not you can actually get those money with mutual funds, I have a video that I made myself because I hired one of Dave Ramsey's Smart Investor Pros 8 years ago when I was 22 years old to help me invest in mutual funds. And I've averaged 12.7% over the last 8 years. I'll put the link to that video in the description below if you would like to see the actual account balances and what I invested in and how much money I have. So it is possible to get these numbers. The 14 or 18%, well, I haven't had that over an 8-year period, but maybe some individual year in there, maybe I did that well. So is Dave wrong? No, though a lot of his skeptics and critics would say it's not really that easy because even as Dave admitted himself, a large majority of mutual funds underperform the market.
Do I recommend good growth stock mutual funds that outperform the S&P above an S&P 500 index, ETF, or fund? Yes. Yes, I own many, many mutual funds that outperform the S&P 500.
So right there again, Dave's talking about the pros of the mutual fund is that the right ones will outperform the S&P 500 index or the stock market.
And yes, I recommend 4 types of growth stock mutual funds. None of those were index funds, by the way. Growth, growth and income, aggressive growth, and international.
So after watching those clips of Dave, we can really break down his philosophy as to why you should invest in mutual funds into 3 different things. Number 1, it's very easy to get started. Now, he doesn't necessarily elaborate on all the reasons that it's easy to get started. The Money Guy Show does. We'll get to that in a second. Getting started in investing is the most important thing you can do when it comes to taking a meaningful step towards preparing for retirement. Number 1. Number 2, they offer a more preferable rate of return than the stock market does if you pick the right mutual funds. Mutual funds should do, as Dave says here, better than the stock market, or this is his claim at least. And number 3, diversification. So the mutual fund itself is diversified, but there's another layer on top of that, and Dave explained right there, he has 4 different groups of mutual funds.
I look at mine once a year. And I have mine split up 25% in growth, 25% in growth and income, 25% in international, and 25% in aggressive growth.
25%, 25%, 25%, 25%. So there's diversification within the fund, and then there's diversification of the funds that you purchase. So that diversification can help insulate you from risk of being too heavy in one particular stock or cryptocurrency or something like that. So Dave's philosophy, his pros, right there. Now let's see what the Money Guy Show says.
So first, let's talk about the pros of mutual funds. Number 1, mutual funds can provide a diversified mix of stocks and bonds and are also not as risky as single stocks.
So there is a large variety of funds, so it allows you to access different parts of the financial markets. You can have international mutual funds, large mutual funds, small mutual funds, hedged equity mutual funds. Pretty much, if you can think of it, there's a mutual fund that can satisfy that itch that you need to scratch in your investment portfolio.
Okay, so right off the bat, the Money Guy Show is breaking down the same thing Dave Ramsey talked about. Diversification within the funds and diversification of the funds, which allows you to mitigate risk, as I mentioned earlier. So they're talking about the same pros so far.
So the next one is you don't need to invest in certain increments with mutual funds. So a lot of funds will have it where you can buy $10, $20, $30, $40, $50. You can actually buy based on the dollar value. You don't have to buy based on share value.
So it's probably easier. Well, I remember I had my high school moment where my economics teacher said, if you guys would invest $100 a month, you'll be a millionaire by the time you retire.
Yep.
It's probably, if you say $100, I want to do $100 a month, mutual funds is probably the thing you need to be looking at.
The way to do it.
That's very easy because you can buy in those easy increments.
And that's a perfect segue. Mutual funds allow for automatic investing. So if you're someone who listens to the show and you think, man, I like this dollar cost averaging thing. I want to have my $100 a month go in and buy XYZ mutual fund so I can be a millionaire. Mutual funds are a really easy way to do that because you can just set it and forget it and let it keep rolling.
So right there they talk about, similar to what Dave Ramsey talked about earlier, it's important to get started and ease of investing when it comes to getting someone actually on the program. They break it down an additional step and say why it's easier. It's easier because you can set it and forget it. You can pick a certain dollar amount to actually invest, and you can buy a proportional portion of the fund. You can put $150, $100 instead of an index fund which may have a fixed price of $380 and you have to pay the full $380 to get it, and you can't really automate that to the same degree you can the mutual fund. Mutual funds tend to be more easy to set up for the beginner, which again, given that both of these financial gurus give advice to beginners, they are trying to dumb it down, make it simple enough that you or I or someone who's a novice can take advantage of the benefits of investing and not have it be too complicated, too complex, or too much of a hill for them to climb to get started.
And then, Brian, I think the last one, this is the one that you talk about all the time. Mutual funds provide great access to really low-cost indexed options.
Right, so then at the very end, it's great access because it's cheaper. It's easier to automatically set it up, or to set it up for automatic disbursement. It's a diversified fund that you're going into, so you have the risk mitigation from moving into an actual fund instead of one specific stock. All right, so moving on to the cons of mutual funds. For those of you out there who watch the Dave Ramsey Show, you know that he almost exclusively recommends mutual funds. Most of the videos that I found to cite here are when someone called in and said, hey Dave, what do you think about index funds? And he quickly dismisses the validity of an index fund and instead talks about how important it is to have mutual funds for all the reasons that we just talked about before. Now, the intelligent investor would say, now hold on, Dave, the question wasn't why is it important to start investing? The question was, what's the better investment, mutual funds and index funds? And you spent the first 5 minutes answering my question with why it's important to start investing. That's not the question that I asked you. I asked which one's better, to which then Dave explains, well, mutual funds are better. They outperform the market. It's easy for him to find mutual funds that outperform the market, so why would you ever want an index fund? Now, it's almost impossible for me to find an actual con that he states when it comes to a mutual fund. But I did find this, so I want you to watch it.
I've got a lot of money in S&P 500s because they have low turnover ratios, and I don't get taxed on them until I pull the money out. And when I do pull the money out, I get taxed at long-term capital gains if I've held it for at least a year. So I use it because it has a low turnover ratio.
So did you get all that? Yeah, me neither. Let me explain it to you real quick. So what he's talking about here is he's admitting that yes, he does buy some S&P 500 index funds. He does buy them. And the reason that he buys them is because they are more tax efficient than a mutual fund. Now, why is that? Now, the mutual fund that's being actively managed by a professional manager, the fund consists of a whole bunch of different stocks or assets. As those stocks get bought and sold and pulled in and pulled out, as the manager manages the fund and removes bad things or sells them and puts in new stuff, there's turnover that happens. Well, those sales generate income. They generate a tax bill because you have to pay tax on the appreciation of whatever you're selling. So then, if there's a lot of turnover and a lot of product being turned over within the fund, you'll have a larger and larger tax bill. That's why Dave actually recommends that you look for a fund that has a 10% or lower turnover rate so that you avoid higher tax bills. Now, an index fund, on the other hand, as he mentioned right here, an index fund is naturally set up to have significantly less turnover. It's just a fund comprised of a certain set, specific amount of stocks, and it's not really being purchased, bought and sold, and new stocks coming in and out of the fund being adjusted. It's just meant to mirror the S&P 500 or a portion of the S&P 500. So there's naturally a lot less turnover. So Dave himself admits that mutual funds can be less tax efficient than an index fund, and that's one of the reasons why he uses index funds. Now, I've got one more con from Dave.
But here's the thing. Listen to this. If your expenses are up 1% higher average over a 10-year period of time, but you make 4% more rate of return, you came out.
I can do that. I can do that.
That's why return is your primary measure of how you pick a fund.
Okay, so right there, Dave does admit that mutual funds usually have a higher fee associated with them than an index fund does. And that's one of people's major complaints about the difference between index funds and mutual funds, is that there's larger fees, the management fees and expense ratios. When it comes to managing a mutual fund, why would you pay those fees when you can have an index fund that does just as good, or if not better, for a less of a fee? Dave's response to that is, well, if you pick the right mutual funds and they're getting 12, 14, or 18%, then does it really matter if you paid more in fees if you also made more down the line? And by that line of logic, yes, he is correct. If you make a bunch more money, then you don't mind paying a little bit more on it because you weren't going to make that money with the S&P 500 anyways. But it all hinges on whether or not you actually pick a fund that does outperform the market. And admittedly, Dave says that a large majority of funds don't outperform the market. And it's up to you, because he never tells you what to buy. It's up to you to find those funds that actually outperform the market. And again, it is possible. I have one myself. I'm not saying he's wrong, but it does require a little bit more work, due diligence from you. Now let's see the Money Guy Show's list of cons.
Let's look at the ugly side of it. What's the cons of mutual funds?
So some do have minimum investments. You might need an initial investment of a couple of $1,000s to be able to access certain types of mutual funds. The next con is that, generally speaking, now not in every single circumstance, but generally speaking, mutual funds are not as tax efficient as exchange-traded funds.
So what I love about the Money Guy Show is they just come right out and they start listing off cons. And I want you to remember, I took this 45 to 50-minute podcast episode and cut it down to what it is right now. They actually go into great length and great detail explaining the actual tax disadvantages and explaining each one of the pros and explaining each one of the cons. I'll put the link to their video in the description below. For the sake of time, I cut it down to what it is right now. So this is another reason why I think the Money Guy Show is superior to Dave Ramsey. If you would like a little bit more advice with your financial advice, then I think the Money Guy Show is probably who you want to watch.
And then the next one is that mutual funds, depending on what fund family or fund company you're buying from, they may have trading fees. So a lot of funds, in order for you to access that fund or that fund family, you might have to pay $25, $45, $75 just to access that fund. And the one thing, and we'll talk about this in a second, but it's kind of, we were trying to figure out, does it fit into the pro column or does it fit into the con column? And we couldn't decide. So we kind of thought it was right in the middle, is that mutual funds do trade once a day at the end of the day. What they do is they look at the underlying value of all the holdings. They determine the net asset value of all the holdings that fund holds. And whatever that price is, that's what you get to buy or get to sell at. So whether you put your order in at 8:30 in the morning or 2:30 in the afternoon, you're going to buy or sell at the same price as all the other investors.
Okay, so obviously the having trading fees, that's pretty self-explanatory as a con. Costs money to trade the fund. But the selling once a day, I agree with them. Is it a con? Is it a pro? Who knows? We'll call it a feature. It's a feature of mutual funds. You can't day trade them like you could an ETF or an index fund or a cryptocurrency or a stock, where they are subject to what the market's doing. They go up and down during the day. A mutual fund, however, has one price on each day, and that price is set at the end of the day. And when everybody trades, buys or sells, they're all buying or selling at the exact same price as everyone else for that particular fund. So it's a feature. Now, the last thing we're going to talk about that Bo and Brian mentioned here is, again, I say it's either a con or pro, because with the mutual funds you can have embedded losses or embedded gains. I'm going to let them explain what that is.
They adjust the price that mutual funds trade at for those distributions. So don't get excited thinking, hey, I'm going to go buy this fund the day before they record the investors of record, and then I'm going to make 14% just because I bought in. No, they'll lower the price of your investments. Yes, you will still. That's why it ends up being a neutral event, but you are going to pay the taxes on that income. So pay attention to that. But look, it cuts the other way. We just came through a bear market. There's a chance if you went on Morningstar and looked at values as of 3/31, there might be a group of mutual funds out there that are trading at a discount, meaning that if you look at, are there embedded losses that are within their portfolios, that means you could buy into a mutual fund and maybe it could make 10 to 15% before it gets back to break even, where you're going to have 10 to 15% of gains before distributions might even come into play.
It's a great, they've actually done, I mean, this isn't really what they did, but they kind of did some loss harvesting for you. We did a ton of this in 2009 at the beginning of the year. We'd actually go screen our mutual funds, and if there was a 30 or 40% embedded loss, and we felt like that fund was positioned well to perform well moving forward, we'd absolutely go grab that. And then we kind of had a tax-free ride for that first 20 or 30%.
That planning opportunity only works coming out of down markets. Now realize, markets typically make money 8 out of 10 years. So more than likely you have an embedded gain in your mutual fund, not an embedded loss.
That's right.
But there are some unique times, twice every decade usually, we just came out of one, that there might be some embedded losses. And in those situations, a mutual fund with an embedded loss is better than an ETF, because every dollar you make from the day you invest with the ETF, you're going to pay taxes as it gains. If you have an embedded loss on the mutual fund, you might have a head start before you have to start paying the tax man.
So there is a benefit to embedded losses. However, as they mentioned, 8 out of 10 years in a decade, the market is up, so it's much more likely that you'll actually end up having some embedded gains. So just beware of that. All right, so let's talk about what they actually recommend. So you've heard Dave talk about the pros, and you've heard him sort of talk about the cons, and you heard the Money Guy Show give their pros and cons, but do they actually recommend that you buy a mutual fund, yes or no? Let's see what Dave has to say.
So if you want to buy an S&P 500 and you want to do it with an ETF, sure, it's an efficient way to do it. I'm not mad about it. I've got a lot of money in S&P 500s because they have low turnover ratios, and I don't get taxed on them until I pull the money out. And when I do pull the money out, I get taxed at long-term capital gains if I've held it for at least a year. So I use it because it has a low turnover ratio. But to use ETFs instead of the 4 types of mutual funds that I recommend, no, I would never do that. because the 4 types of mutual funds that I recommend, I can find them that outperform an S&P 500, which 98% of you dealing with ETFs are doing an S&P 500. And that's okay. It's all right. It's not bad. It's just not the best. My personal 4 mutual funds in my 401k have outperformed the S&P 500 by 1.5 net of fees, after all fees, have outperformed the S&P by 1.5 in the last 10 years.
So you heard it from Dave himself right there. Yeah, you can use an S&P 500 index fund, but it's okay, but it's not the best. And would I do it? No, I do mutual funds, even though he admitted he did have some S&P 500 index funds because they are more tax advantage, whatever. Dave recommends mutual funds because they're easy to invest in. It's important to get started. They're going to outperform the market, get 12% or better, and they're diversified, and there's a diversified amount of funds that you can buy into. Dave is mutual funds only. How about the Money Guy Show?
The point that we're making is when it comes to portfolio construction and design, we're not so dogmatic that it's all one or all the other. But in the places where we do choose to go active, we have a reason for doing that. And that reason usually is not because we want to beat the market. It's not because we think we have some prowess that we can do that. It's because something is taking place macroeconomically that causes us to want to shift assets in that direction.
So what Bo's saying here is when it comes to active versus passive, an index fund is passive and actively manages a mutual fund. And he's saying that when they choose to do actively managed, it's because something may be going on in the market that's causing them to want someone who's an expert to actually manage the fund to avoid a potential issue, and not because they're trying to beat the market. That's a very distinct difference between the Money Guy Show and Dave Ramsey. Dave Ramsey says over and over again, you need to be in mutual funds because mutual funds beat the market and you can beat the market. The Money Guy Show says, no, you should be using a mutual fund or something that's actively managed to avoid the catastrophe that may be coming from some type of distortion in the market, but not because you're trying to beat the market, but because you're trying to anticipate some event. And I'll let Brian continue here.
Distortions. That's what just like when you mentioned quantitative easing.
Yep.
If you go look at index funds in the bond sector, once we continued watching the government go back to pumping so much money out there, you're going to notice it's all the indexes are going to be all governmental indexes. It's not going to have a lot of diversification. You also talk about distortions. Talk about real estate. If you know everybody's now doing Amazon, and we see all these malls sitting out there and traditional big box retailers, that's going to create some weird distortions in the retail sector. So you need to pay attention to those things. But you do need to make sure that if you are paying for an active manager, they better be performing, and they better be even overcoming the tax limitations.
So I want to repeat what I just heard you say, Brian. When it comes to like active and passive, it's not either or. It's potentially both and, depending on the circumstance. Wouldn't you say the same thing could be said for mutual funds versus ETFs? It's not either or. It's most likely a both and, depending on your individual circumstance and what you're trying to accomplish.
So right there, Bo is essentially explaining that you may be using mutual funds, you may be using index funds, or you may have both of them depending on the circumstances. Now, I don't know about you, but me personally, that makes more sense to me. It doesn't make sense for there to be a one answer, a one solution for all people at all times. Dave Ramsey does not make accounts for differences in age, differences in risk tolerance, differences for investing strategies. He just says it's mutual funds, here's some different types of mutual funds, and that's what you're going to use. Whereas the Money Guy Show seems to have a more well-rounded approach, and they seem to be a little bit more humble in terms of, hey, we're not recommending actively managed funds because we know the right people who can outperform the market. We think that we can help you avoid a major catastrophe, distortion, or crisis, and we are perfectly happy with matching or meeting the market and just riding on the coattails of the success of the American economy, and we want you to partake in that. But we're not out here trying to aim for doing better than the S&P 500 index. So they seem a little more genuine in the advice that they're giving. I'll give you this slide real fast so you can see when they recommend that you use a mutual fund. And essentially what they're recommending is is it possible for you to avoid capital gains, those embedded losses, right, that you could potentially avoid? Intraday pricing changes, right? The index funds has intraday pricing changes, whereas the mutual fund does not. Is that something that's beneficial to you? Harvesting losses, and then the automatic dollar cost averaging. Those are some of the big reasons that you may want to do the mutual fund. Let's say you're a newbie investor, doesn't have the amount of money that you would need to get started in index investing, and you can really only put $50 a month away, like I did for the first 6 years I was buying. Well, then a mutual fund's probably the best option for me. So again, their strategy comes down to, is it what's best for you now? Will that change over time? Well, in my case, yeah, it has. I could probably afford to move into something else now. So I really think that the Money Guy Show, once again, just does a better job of actually explaining in great detail, at great length, covering all possible different aspects, pros, cons, considerations, the good, the bad, the ugly, and giving you the most information for free, so that in an entertaining way, so that you can make a well-informed decision. So again, I have to give this video, just like last time, I have to give the win here to the Money Guy Show. I think they continue to do a fantastic job. Once again, down in the comments below, if you're invested in mutual funds or if you're invested in index funds, please leave that down in the comments below. I have a bunch of mutual funds, but after all of this research, I'm trying to figure out how to slowly transition my way into an index fund-based investing strategy, because it seems to be better for where I'm at in my financial journey. And I'm just really currently working on that strategy. Thanks for watching, guys. I really appreciate it. Please like and subscribe to the video. Leave me a comment down below. Message me on Instagram if you want to connect, or DM me, or just chat or whatever. I respond to everyone. I'll put the link to my Instagram in the description down below. Remember, if I made a mistake or something in the video, correct me down in the comments below. I'm not offended by it. I'm a police officer, which means that I got all C's in high school. So I'm doing the absolute best I can with my smooth brain and room temperature IQ. But I rely heavily on you guys, because the chat and the comment section is undefeated. So get down there and hustle for me. Get some work done. If I made a mistake, correct it down there, tag me in it, and I'll see you in the next video.